The S&P 500 is down 7% this year. The Nasdaq has dropped more than 10%, and just yesterday, the Dow surged over 1,300 points on a 2-week ceasefire between the U.S. and Iran. So is the crash over? Is this the dip you should be buying? Or is this the kind of rally that traps people right before things get worse? In the next few minutes, we're going to look at exactly what's happening in the market right now, what history says about moments like this, and the 3 moves that separate smart investors from everyone else during volatile markets. Let's start with why the market dropped in the first place, because this isn't a normal pullback. In late February, the U.S. and Israel launched military strikes against Iran. Iran responded by effectively shutting down the Strait of Hormuz, a narrow waterway in the Persian Gulf that carries about 20% of the world's oil supply. Overnight, crude oil surged to nearly $120 a barrel. Gas prices in the U.S. shot above $4 a gallon for the first time since 2022, and the stock market started bleeding. The S&P 500 fell nearly 9% from its all-time high. The Nasdaq entered correction territory, down over 10%. The economy lost 92,000 jobs in the latest report, when economists expected a gain of 59,000. GDP got revised down from 1.4% to 0.7%. And Moody's recession model put the probability of a recession at 49%. That model has been backtested over 80 years of data. Every single time it crossed the 50% line, a recession followed within a year. We're 1 percentage point away. Then on Tuesday night, everything changed, at least temporarily. President Trump announced a 2-week ceasefire with Iran, contingent on reopening the Strait of Hormuz. The market exploded. The Dow jumped over 1,300 points. The S&P 500 surged 2.5%. The Nasdaq popped nearly 3%. Oil crashed back below $100 a barrel. But here's the thing investors need to understand. A 2-week pause is not a resolution. Iran's parliament has already accused the U.S. of violating the ceasefire. Oil is still way above pre-war levels. And the economic damage from 6 weeks of disrupted energy markets doesn't just disappear with a handshake. So the question everyone's asking, is this the bottom or is this a dead cat bounce? Let's look at what the data actually tells us. Since 1980, the S&P 500 has experienced corrections, drops of 10% or more, roughly once a year. Full-blown bear markets, where the index falls 20% or more, happen about once every 6 years. Right now, we're in correction territory on the Nasdaq and close to it on the S&P. That's uncomfortable, but it's also normal. Here's the number that matters most. After every single one of the 11 recessions since 1950, the stock market recovered. Every single one. The market has come back from a 20% drop, a 30% drop. Even the 2008 financial crisis, when it fell over 50%. The problem is timing. If you sell during the drop and buy back in too late, you lock in your losses and miss the recovery. And recoveries often happen fast. A single day like yesterday's 1,300-point Dow surge can account for a huge chunk of your annual returns. A study by J.P. Morgan found that if you miss just the 10 best trading days over a 20-year period, your returns would be cut in half. Half. And most of those best days happened right in the middle of the worst downturns. So here's what smart money is actually doing right now. Not panicking, not blindly buying, making calculated moves. Move number 1, do not sell into fear. This is the hardest one because every instinct in your body is telling you to get out. But selling after a drop means you're locking in losses at the worst possible time. If you own quality investments, broad index funds, companies with real earnings and strong balance sheets, time is on your side. The market rewards patience. Warren Buffett has said it plainly, be fearful when others are greedy, and greedy when others are fearful. Right now, 72% of Americans have a negative view of the economy. That's fear. And historically, widespread pessimism has been a better buying signal than a selling signal. Move number 2. Use this moment to audit your portfolio. Volatility is like an X-ray. It reveals the cracks in your investments that you couldn't see when everything was going up. Ask yourself 3 questions. Am I over-concentrated in any one sector, especially tech, which has been hit hardest? Do my holdings have real earnings, or am I betting on hype? And can I afford to not touch this money for at least 5 years? If you're heavily concentrated in high-growth tech stocks with stretched valuations, this is the time to rebalance. Not to sell everything, but to shift some weight toward companies with strong balance sheets and real cash flow that can survive a rough economy. Move number 3, and this is the one most people won't do. Keep investing on your regular schedule. If you've been putting money into your 401k or a brokerage account every month, don't stop. This strategy is called dollar cost averaging. When the market drops, your regular contribution buys more shares at lower prices. When it recovers, those shares are worth more. You're essentially getting stocks on sale, but only if you keep buying. The people who built the most wealth through past downturns weren't the ones who timed the bottom perfectly. They were the ones who kept investing consistently and didn't flinch. Now let's address the elephant in the room. Does yesterday's ceasefire change everything? In the short term, yes. Oil dropped 15% in a single day. Markets surged. But a 2-week ceasefire is a pause, not a peace deal. Negotiations are expected in Islamabad on Friday. Iran has already said the U.S. violated terms within hours of the agreement. Oil is still around $96 a barrel, far above the $70 it was before the war started. Gas is still over $4, and the Fed is stuck. They want to cut rates to help the economy, but cutting rates while oil-driven inflation is rising could make things worse. The honest answer is nobody knows what happens next. Not the analysts, not the fund managers, not the talking heads on TV. And that's exactly why your strategy matters more than your predictions. So here's what you need to take away from this. The market is down. That's real. A recession is possible. The data shows that. But the market has recovered from every single downturn in modern history. Don't sell into panic. Audit your portfolio for weakness. Keep investing on schedule. And stop trying to predict the bottom, because the best investors in history will tell you the same thing. Time in the market beats timing the market every single time. If you're just getting started with protecting your finances, our video on building an 850 credit score is the foundation you need, because your credit health determines how much every financial decision costs you.